Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from David Hayes, managing partner at BP Ventures. David, could you take a few minutes to share your story and how you got to where you are today?
Yeah, so my path to venture, actually, I think it was Jacqueline from Munich Re that said that she didn't know what corporate venture was or venture capital was before she got into it. And I'm absolutely in that camp. I started life in BP almost 19 years ago now as a financial accountant. In fact, sort of tracking my history back to how I got there at the age of 11, almost 30 years ago now, I did a week's work experience in an accounting firm. Read a bit about the subject, and my sort of childhood brain at the time saw accountants as these kind of white knights looking after the investors that wanted to protect their money. So I kind of decided that was the career for me at that time. I did my A-levels, went and did a degree in accounting. I'll be honest, I think this is actually similar to James Mawson. Not the best student, I'll be honest. I was not doing particularly well in my degree, if I can be candid. But I spent the third year of that 4-year degree working for BP. And it turned my head around. I almost immediately knew I wanted to work in energy and actually work for BP. It was such a fantastic experience that year. I spent in London in the finance department. So I went back to uni, graduated, joined BP as a graduate, and then through evening school and weekend studying, I managed to get my accounting qualification. So a hard slog, 4-year degree, and then 2.5 years working and studying at the same time to become an accountant. And after my first set of really large statutory accounts that I had to write and get audited, I did my level best to get out of accounting as quickly as possible, because that sort of rearward looking view is good for some, but I thought there was actually more to working in energy and more to working at BP. And through various roles and jobs over sort of the next 8 years or so, I ended up being the financial controller for a little group called Alternative Energy Ventures, and this was back in the 2007-ish timeframe. And so really, I was there as the planning and performance financial accountant for the group. I was wheeled out every month, every quarter to update the plan and the view of what we were doing, and just started to little by little get a little bit more insight into what venture capital was and what corporate venture capital was. I think there was a good conversations. There was a couple of really great folk in the team at the time. I'd now gone on to do different things, but it was really through engaging with them that I got a little bit more involved in strategy and sort of portfolio shape in terms of coming up with better KPIs for the team. And little by little, I started elbowing my way into the team more broadly to actually help with financial diligence. And so I think getting a little bit more involved, sort of bringing a bit more of a commercial lens or a financial lens to the work that we were doing and the investments we were making. And then 10 years later, here I am, managing partner for the commercial side of the group. So my role broadly encompasses the investment processes and portfolio management processes, as well as the economic modeling for deals and term sheet negotiation, structuring and exit sort of management. So we're a team of about 15 people, but 5 or 6 of us very much focus on the commercial side of things and making sure that we make smart investments and that we look after BP's dollars. So yeah, for me, it was that sort of 2007 moment. I had no idea what venture capital was, even as an asset class, and various roles of stepping through and up the organization to now leading the commercial side. So yeah, it's been a fantastic journey.
Thank you, David. I'll start with a very simple question, but I think it's a good one about your background, which is you started with a finance background. How much of that do you think is useful for your current role, as well as how much of that could create the wrong bias for making the right assessments?
That's a great question. So I am biased. I will state that up front. I think a financial accounting qualification, or at least a basis, is fundamental to make smart decisions when it comes to investing. I think absolutely you can invest through a technology lens, but I'm actually speaking to a class at Berkeley in a couple of weeks on why just the technology isn't enough. I would say we in BP invest in people, not in technology, because great management teams are required to make these companies successful. But you also need to really focus on the size of the market, the product market fit. how they're going to make money. You've got to be cash accretive. You've got to be able to solve a problem and make money doing it. Otherwise, you won't be successful. And what I would say is for corporates, depending on the model that you have, some of us are very much focused on the strategic.
Could you share your annual budget fund size, the size of BP itself, and what would BP Ventures moving the needle for BP look like?
The size of BP itself, I think we're, depending on the share price, in the sort of 70-ish billion market capitalization in and around that range. BP Ventures, we have invested around $850 million to date. But what I'd point out is those first several years of investing, we were investing between 0 and 50 actually. We had a few years where it was really quite low. For the last 2 or 3 years, we've invested around $150 million a year. And our forward-looking plan is to maintain somewhat that level of investment. I will say we recut our 10-year plan every year. There is the opportunity for that to change, but I think we feel as a group that in and around that 150 for the current activity set and the current focus and support we provide BP is roughly the right order of magnitude. So 850 million to date, we've invested in around 60 companies through that. I would say 40 of those, 35 are still live. And in terms of what we've delivered to the parent, I would say we feel fairly good with our track record.
Very nice. And maybe from a tactical point of view, how do you document all these successes to R&D and to the businesses? And how do you put that into a storytelling?
Storytelling, that can be a bit of a challenge. Fundamentally, corporate VC is quite a complicated activity set. So certainly if you're investing in different things in different places. So we started investing in hedging technologies, essentially, and we've spent the last 10 or so years investing for deployment. So opportunities to access technology. And I say now we're also dipping our toe in the sort of try before you buy or invest to acquire. And that's partly because we've created a fantastic new vehicle for us called BP Launchpad, which is a scale-up vehicle where we would take majority ownership, throw resources at an idea, and then try and get it to a scale where it's actually more material and meaningful for BP. So I think that whole piece of being able to invest for learning, invest for deployment, and invest for acquisition, the three legs of the stool for corporate VCs is important. We have invested where the strategic value is qualitative. So an investment in a fast charging battery technology company was really around putting BP's weight behind ultra fast charging as a concept. There was no real way we were going to be buying those batteries or using those batteries in our operations, but it was really around creating market pull in a particular way. We've got companies where we've deployed them, and that's actually our business unit reports back to us the dollars on the P&L that they think they've generated from revenue or they think they've saved through cost savings. So I would say from a strategic value perspective, probably in 9 out of 10 cases, we take a very quantitative approach where the business reports to finance the value that they've seen from the deployment, and then we hold that as MI. And then obviously our returns on investment are cash in, cash out. We try and package that all up in terms of a story around individual funds because they do have slightly different strategies and a slightly different return on investment profile, strategic versus financial.
Okay, very nice. So one thing that's very obvious is you have had a few changes of CEOs.
Yes.
And when I started, people said you're only a CVC when you have survived one CEO change. Mm-hmm. I think you've done 4 of them. But on top of that, you have a few changes even on the structure of the investment committee. Mm-hmm. Can you talk about the transitions and maybe what you've learned through these transitions about best practices?
I think you're right. We did start when it was Lord Brown, and now Bernard Looney took over in February of last year. So yeah, I think 4th CEO, I'd say largely maybe our 3rd, if not our 4th iteration of the investment committee. And I'd definitely say our 3rd mode of investing in terms of what we're looking for. You've got to be open to tell the story again and re-explain and retread ground, I think, in terms of why does your corporate venture in the particular way that it does, what has the track record been, what have the lessons learned. It's a kind of a complicated activity set to get your head around with a number of different levers. And I think spending the time and being open to talk to whether it's new investment committee members or a new business unit CEO or whatever it is just have that dialogue and be very transparent. I think just taking the time to actually walk through how you do an economic model for a startup, how you forecast strategic value deployment, what the governance process is. There's always a bit of a story and a track record. For us, we changed from an investment committee that was essentially just the head of a business unit. Because we were investing in hedges, there was always a bit of conflict between what the business was doing and what we wanted to do, and that had to be managed in the right way. We then moved to an investment committee that was very technical focused. And obviously the technical experts we had around the table had long track records of technology not working. And so it's having the right dialogue and making sure that you can actually narrow in on the perspective that made sense for the investment that was being considered at the time. Now we have an investment committee that's very strategic focused. It's about, does this have strategic fit with BP? What is the value from that strategic fit within BP? And then it's the question of why do we need to use venture capital to access that strategic fit? I think they're all great questions, but there's certainly a different perspective of going from, is it going to work, to we tried that before and maybe we shouldn't do it again, and then now does it fit with the company in this energy transition that we're going through? You just got to know what you're doing, I think, and know how to articulate it. I think that's key to manage those transitions.
Very nice. And talking about investment committee, normal question is to ask, what's the size of the investment committee? And you had the chance to have multiple iterations. So what do you think is a good size for an investment committee?
It's interesting. Whenever we talk about investment committee, we have to also understand the level at which it operates within the organization. Because we can just say, oh, my investment committee is 5 members. If that's your 5 most senior people in your organization, that's probably going to be quite challenging in terms of getting people to actually get around a meeting to actually consider an investment case. So I would say we've slimmed it down. It's now 4 members, and 2 represent more of a functional bias, so finance and legal. And then our chair is David Eiton, the EVP of Innovation and Engineering in BP, and he's been the chair of our investment committee now for 7 or 8 years. And then we have an SVP of strategy engaged.
Very nice. And so you do a monthly for investment committee. What happens if you don't have investment proposals to make? Is that a reporting time or you just cancel it?
We can give the time back if we've got nothing. BP's just gone through a massive transformation of itself as a company. It's announced by Bernard in February on our mission to net zero. So there is a lot of reprogramming the organization going on right now, and ourselves included. Of our 4-member investment committee, only one of those members actually knows us as people, right? So we're having to engage with those 3 other folk, not only through the venture activity, but through our lines of influence within your legal function and finance function, everything else, to really explain why we're doing what we're doing.
Very nice. Now I want to shift gear and move to something which is probably important, especially when you look at all the new CVCs coming up. GCV talks about between 20 and 25% of minority equity investments from corporate are new corporates. Mm-hmm. So clearly there's a need to raise the bar. That's also why we do these interviews. What's your view about how to measure the quality of the CVCs, and what would be meaningful benchmarks?
What we're seeing now with the various market dynamics that we're facing, companies are staying private longer and longer. Now, obviously, there's the whole SPAC thing, which we maybe don't need to get into right now. But these are long-term relationships, and that's how we see them. We see them as relationships. They're not investments. You essentially get married to your founders, right? And occasionally there can be some changes through the evolution of a company. But these are long-term commitments. So I say longevity is definitely something in there. I think consistency is you're not changing your model too much. You're not changing board members too frequently, that they know they're going to have a team that is actually going to be there throughout that journey. And so I think making sure that the folk that you have in your team are part of some sort of accelerator program internally, that are kind of spinning in and spinning out and going on to do other things, making sure you can incentivize your staff, making sure they feel good about the job they're doing, that they feel a commitment from the company to them to do this activity. I think creating that kind of long-term mindset, both on an investment place and on a team kind of dynamic, I think is actually important.
I think consistency, especially around behaviors, is what defines a brand. If you want to be known for certain things, you have to be extremely consistent. I want to triple click on something you mentioned about the follow-on investments, because indeed it's a commitment. You're serving the entrepreneurs. how do you think about the follow-on investments? And I want to understand, when would you decide not to do a follow investment? When would you simply do a pro rata? And when would you consider a super pro rata? What would be the considerations?
So in terms of follow-ons, all the way back in the distant beginning of VP Ventures, every single dollar we put into a company had to go to investment committee. So that meant every single follow-on had to be reapproved, which presented a couple of challenges. Certainly for you as a board member or a person engaging with the company, even though you're wearing your fiduciary hat and we have a separation between shareholder and board member responsibility. So for the companies I sit on the board of, I don't get to make a decision as to whether or not we follow on. Someone else in the team is charged with that to keep me clean, focused on the company, and they take the shareholder view to make sure we manage any sort of dynamic there. But we have moved to a place now where we take initial investment cases forward with a concept of lifetime investment. Now, obviously, that can't be from birth to death. It's more from a stage kind of perspective. So if you're investing in a Series A, your lifetime investment probably gets you through to your Series C kind of growth phase. If it's later, it's probably something a little different. So we do try and articulate that. And then follow-ons are actually managed within the team. But ultimately, we have the authority, when strategic alignment goes away, to manage our investments from a financial basis, just to make sure that the business is performing. It still makes sense. It may have pivoted, it may not have. Maybe it's just our strategy has changed. We're able to manage it as a financial investment, making sure that we keep an eye on our strategic value return and our financial value return as a combined IRR of the portfolio. But to your question on not following on, it's the hardest decision to take. We typically say that if a company is performing, we want to maintain our stake, allowing for the fact that if it's a big new round, the new investor will set how much is available to the insiders. We'll always be flexible there. Sometimes we really, really want to take our 10%, but the round's oversubscribed, so maybe we come down a little bit. We try and facilitate what goes on and take a sensible view. Where we see real strategic alignment, and maybe it's in this try before you buy mentality, we might then double down, triple down, and increase our ownership with the idea of potentially acquiring in the future. But the decision to not follow on is the decision we all hate. We hate having to have that conversation. Aside from sitting on the board of a company and realizing that you've got a cash crunch and you need to maybe let a few folk go, I would say the decision to follow on is the hardest investment decision you'll get to make. But sometimes some ideas just don't work. They're just not scaling. They just aren't generating the margins that they were set out to do. We try and do it in the gentlest way possible. I know that sounds like total BS, but what we will try and do is facilitate as much as possible, either handing off to a new set of investors or being there to answer questions as to why, and really opening ourselves up to explain the decision. We realize the weight our name carries on someone's cap table, and our decision to not follow on is terrible for the company.
Actually, there is one thing which I find very interesting in what you said, which is new concept for me, which is when you invest in the company, there is clearly a strategic alignment. Mm-hmm. But you mentioned something which I didn't think about, which is at some point, maybe the strategic alignment goes away and you need to follow the investment. And so the question is, would follow investments take into account the strategic alignment still to decide, for example, between a pro rata and a super pro rata, or it's really purely about financial and serving the entrepreneurs?
I'd say it's almost purely around serving the entrepreneur and what makes sense for the company and for us from a financial metric basis. In our previous incarnation, we had a financial IRR target and a strategic value target for every deal as we took it to investment committee. We've now blended those together.
So I have a question. We're moving to KPIs now, but I have a question which is about how do you build a CVC team? And I want to start with, how do you build a CVC team that will have a really good alignment with your mothership?
The primary incarnation of the team, most of those folk actually came from technical roles within the organization. And so they're able to speak the same language when it comes to pain points and technology deployment and why technology should work. So they have that internal network of being able to talk the same language. So I think interconnectivity is actually really important in corporates, certainly when you're wanting to drive strategic value. I think hiring in folk from external, where they don't have that internal network, is probably quite tough. Now, we've got a couple of great folk that we brought in from external. So Megan Sharp, who's our head of ventures, got prior experience in VC before joining us. And she managed to build that network in those early days with the biofuels team. Also, Erin Halleck joined us from the British Growth Fund in the UK. And she's on that journey right now, building the network internally, but being able to leverage a strong technology experience and investing experience. I think having a good mix of folk that are interconnected into your corporation and folk that hires in.
Very nice. I have a really good question, and I realize that we touched on it and hinted on it, but we haven't actually really been specific about it, which is beyond driving collaboration between the startup and your own corporation, how do you add value to startups?
I'd like to say through sitting on the board of the company, that the folk that we have sitting on boards have been in the energy space, in venture for between 10 and 20 years, either with a strong technical background that can actually help with the particular technology of that company, or with a finance background to help you on your audit committee. I think there's a different way we can all leverage our skill set. I'd say reasonably well networked in terms of finding co-investors, in terms of finding new employees. We've got a great legal function, a great tax function. We've got a great communications function. So I think as a company, I'm not saying we're a full service shop. We are very conscious of our venture offer, though. We are definitely more than dollars. So hopefully you'll get a great board member to help you grow your company. Hopefully that board member will be able to leverage BP, the parent, in whatever way necessary. And then as a group, we're able to find co-investors, introduce you to banks, introduce you to good law firms, IP firms, search firms. We will do whatever you need us to do. It's servant kind of offering, I think, for us.
I like the term servant, and I like the fact that everything you touch is what matters for a startup to be successful. I finally want to touch about KPIs. So you've got this 15 years of experience running this corporate VC, many changes over time. Which KPI has stayed pretty much the same? And which ones have you introduced in the last 2-3 years that you actually feel very good about?
So we haven't really changed a lot. I guess what has changed is we now feel comfortable stating what our KPI is. So we obviously framed this up in the very early days. Venture capital, you invest in 10 companies, 1 is a success, 2 wash their face, and the other 7 crash and burn. I would say we've now introduced a KPI where we expect our loss of companies to be far less than 70%. And that's partly because of the strategic programming and making sure there's that connectivity. If BP can get comfortable with the technology and the company and the startup will be seen as a good business plan and a model, the chance of failure should be lower. So we're saying that we think we can do better than a 70% failure rate. We think it's actually better than 50%. And when I say failure, it's no strategic dollars and no financial dollars from engagement. I think IRR over the lifetime of the investment is one that stayed pretty consistent. I would say what's happened though is we've increased the hurdle that we expect to deliver.
Okay, we are in the last 2 minutes of our interview. I want to end with an inspiring question. What do you think is the value of corporate venturing to solve these energy-related problems? What can we expect to see being solved with corporate venturing?
We as a company have committed to net zero, and not just for us, for people and the planet, and to help others get there. I see ventures as a core part of that strategy and activity of delivery. There are technologies out there that we're going to need, that are going to transform, and they may not be obvious today. So we should be there as a scanning function. We should lengthen the perspective of any corporate that we're working for. We should be raising awareness of potential disruptions, raising awareness of technologies that are potentially going to beat what we have internally. Finding the really smart people out there that have ideas that maybe don't fit into a corporate structure because they don't really like how a corporate feels. But we're there to find them, to fund them, and to grow these companies into the next generation of energy and how energy is actually going to work in the future. I mean, we're moving from an IOC to an IEC. That's a big transition. We're here to try and help find the people that are going to help us do that because we can't do it alone.
It's a perfect way to end an amazing interview. Thank you.
Thank you, Nicholas. Thank you.